Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this INDepth for the Inside Network, exploring deep tech and its opportunities, but also answering some of those riddles around some of the perceived challenges. We have the managing partner at WNT Ventures, Carl Jones. Welcome, Carl.
Thanks. Nice to be here.
So, Carl, a lot of advisors, they find it quite an exciting theme. Significant upside, but also the benefits for our planet and our society. But then likewise, there'll always be some hesitation about certain concepts. So, for example, you look at Kiwi, New Zealand-based incubation and opportunities. How does that compare? Presumably as a geography, it's a bit smaller than some of the more mature markets. I'm thinking, for example, the US.
Yeah, it's a good question. I think, what we've seen in New Zealand over the years is that New Zealand has consistently punched above our weight, right? Who would have thought we had a space industry for a start? And the amount of Hollywood blockbusters that are made in New Zealand doesn't equate to Hollywood, And so I think the same is with startups, to be honest with you. We've seen a lot of amazing companies coming out of New Zealand. And the founders that we've got within those companies, one of the factors that I think causes that is the small and relatively isolated nature of New Zealand itself. We don't have a market in New Zealand that the founders can grow into. So what we see is they start with a global mindset from the very beginning, and they take that into the markets that they take their product into the markets that it needs to be in. And you compare that with the US, where those founders in the US are typically focused on the US only for a very long time before they think globally. Yeah. We think globally really, really quickly in New Zealand. So I think that's a big part of the fact of it reduces that risk and allows us to perform way above our size.
You touched on startups. That's presumably the riskiest end of investing because it's a nascent business model. It might have some really exciting IP, but is it actually going to generate the revenues you dream of? Can you talk to an advisor on how you mitigate those risks?
Well, look, we're a high conviction active investor. We mitigate those risks through a really thorough diligence process. We dive very deeply, probably deeper than people think we can dive in at that early stage. And we try and understand what the opportunity is globally. We try and understand and add value to the company as we do our diligence. And then as an active investor as well, we feel that our hands-on approach really helps to support those founders as they grow globally.
You're in that interesting space where you're supporting businesses to get up and running, but presumably it's a long and arduous journey to take a business model that's a dream into a viable, profitable, exciting business that investors can then get their stake returned. Is that an accurate portrayal, or is there a bit of a misconception about the length that you need to stay invested?
It's an interesting concept because I think we've looked at it in a variety of ways. So deep tech, which is what we're focused on, generally is perceived to be a really long process, long timeframes to get to a liquidity or some sort of value inflection point. And for the most part, that's true. I think what we've done well and what we've focused on is getting a variety of opportunities within a fund. The fund provides diversity in a variety of ways, and that might be from the way where we invest into some companies, which we can see the opportunity to get quicker returns. Not every company can become a unicorn, right? They named that for a reason. But what we've seen in both in a smaller fund and a smaller country is that we can see some great opportunities for some mid-sized companies. And if we're capital efficient, which New Zealand companies are very capital efficient, we can actually get really healthy returns from that. And then the balance of our portfolio is the slightly longer term to maturity, and we can provide early liquidity for our investors, then provide them with additional upside through the longer term maturity of the rest of the portfolio. So we achieve diversity not just in sort of sector based or or stage-based, but also from how do we see liquidity potential in these companies in the short to medium term. And we've got track record of doing it. We've been able to do that successfully in multiple funds now.
Now, those funds that you referenced, if I think about the universe that advisors consider, they are on the smaller end. What does that do in terms of the journey, some of the hesitations that an advisor or a client might have?
What I think one of the points is that we're right-sized for the New Zealand market. It's a small market. We can capture, we invest in 5-6 companies a year. We look at 200 to 250. So each of those companies, we look at its ability to return at least 20 times the investment. And each of those companies can return the fund themselves. Now, when you've got a bigger fund, that becomes much more challenging because you have to hit a unicorn or thereabouts every single time. Now, those are really hard to achieve, as you could well imagine. Yeah, sure. So having a larger fund has its own unique characteristics, but having a smaller fund gives us much more flexibility in how we deploy capital and how we seek liquidity at the back end as well. We can often get liquidity earlier because we're at seed investing. It gives us the opportunity to look for a variety of liquidity events, whether it's a management buyout, a secondary sale to an incoming investor, or a full acquisition. Whereas the larger funds don't tend to be able to have that range of opportunities just because of they're either investing at a later stage or they're investing such significant capital. There's there's a lower number of liquidity events, IPOs about it, or a major trade sale. So that's kind of the lens that we bring to some of that.
And you referenced, Carl, the journey you've been on. The fund sizes are growing. Is that a fresh challenge? Particularly, as an investor, would I want to sort of see that there's a track record of building the scale of your funds?
Yeah, look, and the way we've sort of looked at the growth in the fund is we've been growing with the growth in the New Zealand market for a start. We've been around for 10 years. The market has changed. In fact, Fund 4 that we're raising is fairly equivalent to the current funds under management that we've got in its entirety anyway. So the jump from Fund 4 from the previous funds is not all that great. The other thing that's happened in the market is the round sizes have tended to increase a bit. And the amount of capital that we're deploying has remained reasonably static to date. But what we've been doing is syndicating with either other investors or our own limited partners. So what we'll see in Fund 4 is a bit more allocation out of the fund, and then strategic syndication where it makes sense to bring other investors, whether they're our LPs or international VCs, to deepen networks, deepen the pools of capital for those next rounds. So for us, the allocation of capital was in the first round is just as much about thinking about where does the next round of capital come from and the capital pathway for those companies as our own metrics and our own allocation.
I think you've covered off a lot of these interesting questions that advisors have about deep tech investing. You're obviously going to keep growing for the next decade. So thanks for your time, Carl.
Thank you. Appreciate it.